Joining us right now with his reaction to the data is former Fed Vice Chairman and CNBC contributor Roger Ferguson. For anybody who's just waking up, the numbers that just came in were quite a bit better than had been anticipated. A gain of 178,000 jobs in March versus the 59,000 that had been anticipated. We did see a revision that showed a bigger drop in the prior month. But, Roger, people's perspective on these things often depends on where they sit. And I wonder if you'll indulge me a little bit. Let's play a game that you are still the vice chairman at the Federal Reserve and see what these numbers mean to you from that perspective. What do you think, first of all, just of the jobs number, the unemployment rate?
So, look, I think the jobs number has to be recognized as a good number. But as you point out, if you sort of average through the last 2 or 3 months, you'd say, perfectly fine, but nothing too exciting about one way or the other. I think from the standpoint of the Fed, the big question was, is there continued evidence of a labor market that is stabilizing? Remember, they had been cutting out of a concern that the market might weaken. And one would look at this set of numbers and say, feels pretty good. The job market is indeed stabilizing. So let's make sure we focus on both sides of the dual mandate. Same thing is true with the unemployment rate. Could have gone up slightly. There had been some concerns about it rising. Looks like it's stable at 4.3 or so. And overall, given some of the other conversations we've had, this feels very much like the low fire economy still in place. So I think from the standpoint of the Fed, good news, which is wonderful, stabilizing labor market, which is what they needed to see, but still low fire, which is an equilibrium that may not be exciting, but is certainly consistent with some elements of the dual mandate.
Steve Eisman was with us earlier this morning, and he's famous for having seen what was happening with the great financial crisis before just about anybody else. He saw the problems in the mortgage market, knew that was going to be a big deal, and started warning about it. He's watching 3 things right now. The first, not in this order, but he's watching the war, he's watching AI, but he said the thing that's most important to him is what's happening in private credit right now. That is a concern because he thinks it's going to mean less lending, making its way into the economy, therefore cutting growth prospects. What do you think about those 3 issues? And let's start with private credit first, Roger.
I think on the private credit front, what's going to happen is you've seen some concerns and you've seen some redemptions for some of the funds that have these gates, so-called. What's going to happen over time, I think, is what always happens in markets, which is some equilibration, which is, put it another way, interest rates in private markets are going to have to go up. The spread is going to have to go up a little bit. But there's, I think, ample money ready to lend. It's all about pricing. There will be some sectors, perhaps software, I don't know, that will be challenged a bit more. But there'll be other sectors that people are ready to lend to. And so, I think private credit is going to equilibrate, not in a way that's really going to slow the economy, though the price of credit might go up somewhat. If we can go to the other 2, I think the war is obviously the big question. Great deal of uncertainty. Chair Powell has indicated that in the face of this amount of uncertainty, the Fed feels like it's well positioned. It's in wait and see, and will decide which way it should move. And so I think we're all just waiting to see when this war winds down. But more importantly, from the standpoint of the war, it's not when does it end, but what happens to the Straits of Hormuz. I think the geopolitics in the region have changed quite dramatically, making the transport through that region, which was always somewhat dangerous, even more tenuous. And that could be a big long tail effect on energy markets, on construction markets, agriculture. A lot of nitrogen-based fertilizer goes through that region, even on helium, which is used to cooling. So I think that's the question. Big question in the war is what's the tail effect look like?
Yeah, helium used for cooling and in the production of semiconductor chips in particular. Is there a point where the Fed says this really matters? Is it when and if it gets beyond just core?
I think it does matter to them because the other thing that they're worried about, and you've heard Chair Powell speak to it, is this question of inflation expectations. Mm-hmm. And most expectations aren't built only around core. People think about, what they actually experience on a day-to-day basis. And the other thing that happens with expectations is your most recent experience. If you've seen pricing going up in general, be it food, be it gasoline, be it natural gas to heat your home, you get an expectation that, inflation is mounting. So I do think all these things matter to the Fed, not just for inflation as measured, and not just for core, but for the other thing they're worried about, which is keeping inflation expectations under control.